an investor education initiative presented by Kotak Mutual Fund in association with ET Now, was celebrated on 26 August 2016. SIP Day is a first-of-its-kind initiative to promote and encourage investors from different backgrounds and age brackets about the benefits of investing early, investing for the long run, and simultaneously the perils of not investing at all. Through various panel discussions and engagement activities, SIP Day aimed to shed light on investing in mutual funds and elucidate the benefits of the same.
In technology is changing the way we react. Everybody wants instant gratification. Aaj lene ka, subaह bechne ka. If I don't say that on TV channel, nobody will watch my TV channel, right? And today I'm talking about SIP Day. So how will these two things match?
See, it's human nature that they want instant gratification. But the fact remains that how many of us are successful in trading? The best of the traders in the world seems to have a strike rate of 40–50%. In my experience, most of the ordinary traders will have a strike rate of about 10%. So 9 out of 10 trade you are likely to lose money, and 1 out of 10 trade you have to make so much money that those 9 trades losses can be absorbed. Now that's humanly impossible. And if that was not the case, then number of traders in India should have multiplied significantly. Today they have remained virtually constant over the last 10–15 years. In most broking company, you see every month or a fortnight, the top customer changing because they come, lose money, go away, and then next set of customers come. So whichever way you look at it, instant gratification hasn't really helped. And the biggest strength which an individual investor, which an individual can have is the patience. The market always rewards time in the market rather than timing the market.
A series of panel discussions were conducted highlighting the importance of investing early. Session 1 focused on the first steps to an SIP. The panel featured Vidya Bala, Head Mutual Fund Research, Funds India; Lakshmi Iyer, Chief Investment Officer Debt and Head Products, Kotak Mutual Fund; Dhaval Kapadia, Director, Investment Advisory, Morningstar India; and moderated by Faye D'Souza, Editor, Personal Finance and Real Estate, ET Now.
If you could give one piece of advice, one takeaway to investors of mutual funds.
There's one thing that I want to tell you from our experience as an advisor to investors. Starting SIPs is one thing, but keeping them alive is another. Many people start SIPs with good intentions but stop them midway either because the market spooks them or because they think they need the money. If they need the money, it's unavoidable, nothing can be done. But please remember, it's because the markets spook you that you are taking the SIP route. You do not want all the volatility of the market. So there is no point in stopping your SIPs when the markets are falling. That's the best time that your SIPs will be averaging for you. You're completely not allowing your SIPs to do their job by stopping their SIPs. So start SIPs and keep them going. That's the one message that I'll have for you.
An SIP should effectively be a sultan of your portfolio, of your financial portfolio rather, which allows you to potentially fight the dangal with inflation in Shan. So that's in a nutshell that I would like to say, or the message to investors as to why investing in equities is important, number one, and more importantly, why the disciplined mode of investment through the SIP route is even more inevitable.
Just a slightly different perspective and just maybe taking a step back, we are all talking of SIPs and, that's the way to invest. But I think one thing you have to keep in mind for all of you investing in mutual funds is asset allocation as well. So, the mix of assets that you have in your portfolio obviously should be sort of aligned to your willingness to take risks, your investment horizon. So obviously if you're younger, you've got a long period before you need to withdraw the money. Maybe you can have a higher allocation to equity, but as you grow older, maybe to avoid sort of disappointment, you hear a lot of stories of people when they need money, suddenly they see the value of that investment has gone down. So it might happen because you've really not, allocated effectively, or you've not sort of reduced allocation to equity at the right time. So that's equally important, as you're sort of approaching your goal, is to reduce your allocation maybe to assets like equity, which over the long term do well, but over the short term we know can be volatile.
I want to open up the floor for anybody who has questions about anything.
My name is Krishnan. Today India is becoming digitally very savvy. So people before starting an SIP, they go to ABC website, it could be Value Research. My question is, how do I rate the integrity of the raters?
There is always an external accreditation for anything. So there is something called self-certification that, oh, my fund is the best, and there is somebody externally telling you that, okay, this fund can be looked at and why not. Now, how much you rely on it is completely your prerogative, but there is a science, there is a method which goes into assessing parameters for each of these ratings which are involved, right from star ratings to the rankings which you see in 1, 2, 3 order.
We use the ratings then as sort of an elimination system. So if you're looking at 5 funds and one of them consistently on various rating systems has a lower rating, you just eliminate it from your consideration set.
Exactly.
It's
so
not the only
yeah.
reason of choice.
Correct.
So you're not the only criteria.
So it allows, as I said, it is a necessary condition, it's not a sufficient condition.
Session 2 shed light on breaking the myths behind investing. The panel featured Managing Director of Kotak Mutual Fund, Nilesh Shah, Hemant Rustagi, CEO, Wise Invest Advisors, Misbah Baksamusa, National Sales Head, NJ India Invest, Certified Financial Planner, Gaurav Mashruwala, and moderated by Neeraj Shah, Senior Editor Stocks, ET Now.
Hemant, I want to come to you first because you kind of echo this thought, right? That even if you start small, but if you keep it for a prolonged period of time, there is wealth to be made. The most common myth is that this 1,000 rupees will not work. But I think you echo that point that even a small start is a great start.
I think the important thing is we need to understand for what purpose are we doing SIP. See, one of the things that everyone needs to remember is SIP brings in discipline into your investment process.
Okay.
To me, I think 50% job is done. What's happening, we keep talking about money all the time. Okay, I want to start investing tomorrow, I'll start, next year I'll start. It doesn't happen. The moment you commit that I'm going to be investing so much money every month on this day in this fund, you are kind of bringing in discipline into your investment process, which clearly means, like I said earlier, 50% of your job is done.
Right.
So you start understanding different asset classes, okay? Everyone talks about equity. We understand there are different perceptions about equity. People think equity can be a risky asset class. Yes, it is risky, but it also has the potential to give you higher return than other asset classes. So somewhere you need to begin. Even if you begin with 1,000, it doesn't matter. But in the long run, what will really work for you is, apart from the discipline that it brings in, that you must align these investments to your goals.
So you're bringing in a concept here, goal-based SIP.
Absolutely.
Not just a plain SIP.
You have to align it to your goals because it does so many things for you.
Okay. Misbah, one other myth that people generally have is that I'm sufficiently invested. If they've done an SIP investment or stock investment for 2 years, they somehow believe, okay, now I'm sufficiently invested, 2 saal kiya hai, bahut ho gaya.
From our perspective is that there are 3 simple theory that works. One is that whenever you are investing, you need to give the time to the investment.
Sure.
So, power of compounding works when you give sufficient time to your investment. The second very important thing is, of course, everybody has been talking about that if you are creating wealth, you need to have a real rate of return. That is a return above the inflation. Then only you can create wealth. So definitely, again, not discussing more, equity is a right asset class which has delivered not only in India but across the globe the real rate of return. And the third most important thing is that as Hemant has rightly said that, that if you really want to create wealth, you need to ascertain the amount. अगर आप बोलते हो मैं 1,000 रुपया दे दूंगा, yes, for somebody 1,000 rupees is his only investing capacity. And even if he does that, it can be a great thing to change his future life. But if somebody has a saving capacity of say 50,000 and he ends up only doing 1,000 rupees of SIP, probably that's not going to change to the life that he is targeting to change. So the very important thing is that you need to ascertain as to what are your goals, what are the purpose of the SIP, and then do the right amount. That is extremely important.
Now, Gaurav, one very important myth actually exists. Okay, let's say I have a goal. 3 years hence, I want to go on a vacation to Italy, and I'll need 2 lakh rupees for that vacation, say hypothetically. And when I call up my bank says कि अगर आप हर महीने का 8,000 का RD खुला देते हो, recurring deposit खुला दो, तो इसका इंटरेस्ट मिल मिला के एट द एंड ऑफ 3 years आपको मिल जाएंगे 2 lakh rupees, 2.5 lakh rupees. So people are happy with that. Now and therefore people don't know whether SIP is a mode to do the same thing or no. Now can you throw some light here?
So one is, yes, end of the day we are talking about a habit and discipline investing, whether it's recurring deposit, SIP, whatever. What is more important is, as everybody has been saying, goal-based. Focus onto it. And in fact, I'll go a step ahead and start naming it. So since he mentioned recurring deposit, if you are doing recurring deposit to go for a vacation, instead of calling recurring deposit, call it vacation deposit. If you are doing an SIP for your higher education, and say if your name is Sita, instead of calling it SIP, call it Sita Higher Education Equity Fund. The commitment of yours and your family will be much, much higher, because then you are personalizing that investment. You're having entire family believing in it, and then every time you put in amount, you feel you are reaching destination slowly, slowly. You are nearing the destination. And the nearer you are, the faster you want to do it. I mean, end of the day, let's look at it. When we calculate compound interest, what is more critical? Is the rate of return or number of years? It's number of years which is more important.
I think one most common myth that people have whenever they started investing is that I can do a better job of picking stocks than a mutual fund manager. Why should I invest in a fund and pay that fund manager whatever 0.5%, 1%, 2%? It's the biggest myth that exists in the minds of almost everybody.
As a fund manager, obviously I meet people who are far, far superior than me in terms of performance. But many a times that performance has come because of the risk they have taken. Many individual investors run leverage. We don't do leverage. Many individual investors do concentration. We don't do concentration. We are diversified. So for the amount of risk taken, I think today's Indian equity fund managers will be better than 99% of direct investors. There will be 1% exception like Rakesh Jhunjhunwala or Nimesh Bhai. Certainly they are far, far superior to us. But 99% will be able to outperform.
August was earmarked as SIP Day, a day dedicated to bringing more and more retail investors and first-time investors to start investing healthy and wisely. Session 3 focused on mutual funds for wealth creation. On the panel were Ashok Kumar ER, Chief Executive Officer, Scriptbox; Mukesh Dedia, Director, Gala Bansali Securities; Dinesh Khemlani, CEO, Verity Fin Solutions; Manish Mehta, National Sales Head and Distribution Alliances, Kotak Mutual Fund. Unmoderated by Tanveer Gill, Senior News Editor Markets, ET Now.
Ashok, maybe you could start off with that. If that's been established, that it's not a high-cost investment, 2,500 each month, systematic investment planning is the route to create wealth over the course of your lifetime, then how do you begin?
Yeah, I think the first thing is getting started. I think that's the first big decision each of us have to take. And I think one of the things in our online platform, we have a lot of youngsters, investing with us. And after they start investing, when you go and survey, the first question is, I wish I started early. At Scriptbox, we now are in 389 cities. We got a lot of youngsters started by inspiring them through very action-oriented articles. So how do we get them started? We just talk about these things, that how much did you spend last weekend? I mean, pizza night or a movie outing or 1,000 rupee SIP. In fact, we even made it easier by introducing 500 rupee people can start on our platform. That's kind of helping, and we have 70% of the people who are first-time investors. And I think once they get started, they don't leave. I think using a very simple jargon-free language is kind of not intimidating them is what it's kind of helping them to get started.
I just want to add to that, the fact is getting started is as easy as going to an online platform like Scriptbox, or going to a broker, or, seeking a financial planner for, advising you on where to invest. Mukesh, let's start off with that. What is it that you are advising your clients to do right now on how they can get into the mutual fund market and make the most of their money?
In India, the basic problem is whether to invest into equity or not. We know that hardly 2% of the money goes into equity. So I tell them just make a very simple calculation. Assuming your 1 rupee is getting doubling every 5 years and your career is of 30 years. You start at 2500, another 30 years you are going to work. Just do a simple math. 1 becomes 2, 2 becomes 4, do it 6 times and your 1 rupee grows to 64 after 30 years. And assume your 1 rupee is doubling every 10 years. It just grows to 2, 4 and 8. The gap is so big between 64 and 8. And हम लोग बोलते हैं कि markets are very volatile. Assuming that the markets crash 50%, like in 1992 or 2000, 2008, markets have crashed by 50 to 60%. So even if your 64 were to crash down to half, just say still you are around 4 times, still more. So that is the difference. You have to cultivate that mindset. And finally, how do you participate in the India's growth story? Just by investing into your fixed assets, fixed deposit, you are not going to participate. Another important thing is about inflation. Government announces that WPI or CPI, which is about 5-6%. But you have to see what is your inflation. And when we have done our analysis with our clients, it has come in the range of 12 to 15%. And we say that investments have to beat the inflation because your standard of living gets added to the core inflation.
Manish, how much is conviction building in mutual funds over a course of a time period, let's say 10 years?
So our experience at Kotak has been that when we've been going and visiting various cities across the country and doing a lot of such IAP initiatives, I think the awareness levels of mutual funds have gone up substantially over the years. One of the key examples would be SIPs. So about 2 years back alone, I think the outstanding SIPs in the industry were in the range of about 30 to 40 lakhs. And just about a few months back, we've crossed more than 1 crore outstanding SIPs. Okay. The kind of financial cushioning that SIP is giving to our capital markets is immense. Like it's almost 3,000 crores of inflow every month just on SIPs. And I think increasingly even partners across the country are realizing that you're in a TINA factor today because over the last at least 10 years, real estate has not made any returns. Gold has not given any returns to investors, and equity is the only asset class which has sort of generated returns for our investors and hopefully will continue to give those kind of returns. So I think that conviction level amongst partners, even amongst investors, and even when I travel to many of the smaller cities, awareness level of SIP has gone up substantially.
I just wanted to come to you, Dinesh, on where to invest, which are the mutual funds to invest. How do you pick?
See, taking off from your risk appetite, all right, typically if you're a first-time investor, the easiest way to do things is go through an ETF. All right, it's a no-brainer. You are investing in the top 30, top 50, top 100 companies which are there listed on each exchange. If you have an advisor, very nice, all right, he would start with putting you into a diversified mutual fund, all right, which probably has a slightly higher expense than what an ETF has, but it generates an alpha which is probably better than an ETF over a longer period of time. So this is presuming that you have a 5-year horizon or you have a 10-year horizon, and then I bring in the mid caps and the small caps as schemes into your portfolio. If you have a short horizon, which is 3 months, 6 months, 1 year, options at this point, the best option that you've got is not even a liquid fund. It is actually an arbitrage fund. You are yielding 6.5% today, tax-free returns, 6 to 6.5% from an arbitrage fund. A liquid fund, you're subject to 28.5% dividend distribution tax. If you reinvest, very nice, you get short-term capital gains tax at 33%. Same with the short-term income funds, it's the same thing with the long-term income funds. It is minimum 3 years investment horizons. So if you've got shorter terms, then you're looking at 3 months, 6 months, 1 year, all right? Then risk is off the table, you sit in an arbitrage fund.
The last panel focused on markets in India and the future of investing. The panel featured Hiren Ved, co-founder and whole-time director Alchemy Capital Management. Prateek Agarwal, Business Head and CIO, ASK Investment Managers. Harsha Upadhyay, Chief Investment Officer, Equity, Kotak Mutual Fund. With moderator Nikunj Dalmia, Chief Editor, Financial Markets for ET Now.
What I want to really talk about here is that if you indeed invest in equities, why will you make money? We've been talking about cycles. You know, in life, excepting age, nothing goes one way. Cycles keep on going. But what cycle are we in? So Pratik, that's my opening point. If somebody plans to invest in stocks, and we're looking at somebody's long haul, 5 years, what is the case that money will be made?
The case at the present is pretty strong for the simple reason that we all believe that over the next 5 to 10 years, this is going to be decade of India. The growth rate that we are going to see would be faster than what we have seen in our own history and maybe faster than most other large economies globally. Combined with that, you also have a prospect of interest rates at lower levels getting further lower, given the fact that in the rich world, interest rates are already close to zero. So that combination in itself is a great combination for asset values going up. So in case the asset that you are buying is able to retain its pricing power in terms of the yields that it has today, in future those yields are going to be worth much more.
Hiren, in India, either we do FD or we think FNO. I mean, people, either they'll buy Nifty futures or the money is lying in fixed deposit. That's the way how it works. But it's beyond that way. And the pitch to buy India is actually beyond that.
Yeah. I think it's quite surprising that, while we endure everything else in life which is variable, but we don't want to do that when it comes to our investing. Essentially, the biggest mental block that I have seen to investors wanting to invest is not coming to terms with the fact that this asset class delivers. They all believe that, okay, I don't think they debate, or most people when I talk to them about investing in equities, they don't debate that it's a compounding machine, that it can give you 15, 20, 25% return over a long period of time. What they are most worried about, the fact that they can't reconcile in their mind that when I invest an X amount today, potentially it can be down 5% tomorrow. Right? Because that doesn't happen in a fixed deposit. But the fact of the matter is that once people reconcile that, and that's why intuitively speaking, people like real estate as an asset class, because they have this frame of reference in their mind that once you buy real estate, it never goes down, it only goes up in value, which is true. Over a long period of time in a developing economy, real estate prices will go up. But there are other challenges that you have in real estate which you don't have in equities. And I think the biggest lesson of equities that I got, and I came to the equity markets courtesy my dad, but I think he, had a very commonsensical view of why he thought equities was a great place to be in. So I think it's liquid, it's tax-free, and you are able to capture the value of the opportunity that exists, and some smart guys who have the ability to capture that opportunity.
Harsha, when you buy a house, you don't look at your paper and check the price of the house. The gold is lying in your locker. But when it comes to equity, you check the price. Why does it happen like this way?
What is equity investing? Equity investing is essentially investing in a business. Is there any business which gives you money on an overnight basis? There could be businesses, but those are not sustainable. So when you start a new business, when you partner a business, you have to give time to that business to grow. And if that business is doing well, if the returns earned in that business are higher than the cost of capital that is employed in that business, on a sustainable basis, you will definitely make wealth. And that is what equity investing does for you. Instead of starting your own business, you can partner any business that is doing well. And look at the positive aspect. There are promoters who have been doing a particular business for maybe 20, 30 years. If that industry is not doing well, and if they are not able to get out of that particular business, they still have to run that business. But as investors, you have the option to look at businesses which are likely to do well in the future. If you don't like something, You can exit that business and enter a new business. You will start to look at what the value creation is over a period of 3 years, 5 years, 10 years. I think that is how you will be able to build your wealth.
Thank you very much. You've been a lovely audience.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.